Okay.
So this is exercise 1H. Exercise 1H is an exercise that is in the textbook, but then you have in your first assignment, you will
Yes.
have a similar question to this,
Yes.
and then in your test, you will have a similar question to this. So
Okay.
if you can do this question and you understand the reasoning, then you will be able to do the test as
This one.
question and the assignment question as well. So here's what they say. It says transactions for Redgrave traces for January 2001. They use a perpetual inventory system. They have a markup of 50% on cost, and we are ignoring VAT. Now, part of the problem with this question, of course, is that they are using concepts that we haven't dealt with yet. So, firstly, perpetual inventory. Perpetual inventory simply means that we record things in real time.
Yes.
So there is inventory and there is a cost of sales immediately. Okay, while if it was not perpetual, then it would means that we would have a stock take on a monthly basis. But for now, they say perpetual, so we know that it's going to happen in real time. They have a markup of 50% on cost. So what does it mean? If something is costing 100 Rand, then we are going to take 50% of that 100, which is 50 Rand, and then we are going to sell it at 150 Rand.
Excellent.
This is what it means to have a markup of 50% in cost. But when we get to the second chapter, I'm going to show you how the two markup systems work. So don't worry about it now. And for now, we are ignoring VAT. So here's the transaction. It says on the first. And what we must now do is we must show the effect of these transactions on the accounting equation. So it says on the first, the owner takes clothing from trading inventory for personal use. And the sales price of the clothing is 1,500. Now, first thing we need to do is we need to say, okay, so trading inventory is an asset account.
Yes.
Okay. That asset account is going to decrease by an amount. Now, yeah, I say to you it's 1,000 Rand, but we don't know it yet. I'm going to show you how I get to the 1,000 Rand. But there are things that we can fill in before we even have the amount. So we can know that it is trading inventory. We know that it is decreasing. We know the date, and we know that an asset account, if it decreases, we are going to record it on the credit side. What is happening here? It does not create a liability, but we know that our owner's equity is going to decrease because there will be less stock in the company. It's going to decrease by the same amount, and we know that the account that is affected is the drawings account. He takes clothing, so it's a drawing, and that is going to show on the debit side. Okay. Now, how did I get to the 1,000 Rand there? Well, we know they have a 50% markup on cost.
Yes.
So the sales price of 1,500 includes this markup. And so to get to the cost price, we can simply divide by 1.5. If the markup was 60%, we would have divided by 1.6. But now because it's 50%, we divide by 1.5. 1,500 divided by 1.5 is 1,000. Sorry, oops, I must go back. That is how I got to the 1,000 there. Okay. Then on the 8th, they pay 10,000 Rand to SA Property by EFT for trading inventory. Now see what's happening here. Yes, the date is given. That 10,000 Rand is leaving the bank. Because it is leaving the bank, we know that the bank asset account is decreasing on the credit side by 10,000. But trading inventory is also an asset account. So
Yes.
in this case, we are simply trading one asset money for
Yes.
another asset trading inventory. And
Yes.
so we are going to debit this asset account, debit trading inventory, because it is increasing, and it is increasing with the same amount that the bank is decreasing.
Decreasing.
So really the net effect is zero, because plus 10,000 minus 10,000 is zero.
Yes.
So the real effect on the accounting equation is nothing. Then on the 10th, they buy computer equipment on credit
Credit.
for 5,200 from Incredible Computers. Okay,
Yes. Yes.
so the asset account that is going to increase is computer equipment. That's the one that's increasing. So it
Yes.
increases on the debit side to the
Yes.
tune of 5,200. But in this case, we are not paying for it in cash like we did there. We
Yes.
are buying it on credit, so it creates a liability for the same amount, obviously. And we know that this increase in liability will be recorded on the credit side, and we are going to call this liability creditors control.
Yes.
Okay. Next one. On the 15th, they sell trading inventory on credit for 4,470. And now look what's happening here. The first thing that happens is, because we are selling it on credit, our debtors control is going to increase. Now, debtors control is now our asset account here. It's increasing on the debit side to the tune of 4,450. Okay.
Yes.
And at the same time, our owner's equity is increasing with the same amount, and it's an income account called sales. So our
Yes.
income account is sales, our asset account is debtors control, and obviously they must be the same. But now, be careful, because we are working with a perpetual inventory system.
Yes.
The trading, we must now account for the trading inventory that we are selling, because that's going to decrease as an asset account. We're going to have less inventory to sell because we are selling some of it now. So the trading inventory is going to decrease, and so we are going to credit it. And on the other side, it is going to be an expense account, and the contra account, expense account here, is called cost of sales.
Yes.
Okay. Only thing that's left for us to do is we need to calculate this amount. Once again, we know they have the 50% markup on cost. So the sales price of 4,470 includes the markup. To get to the cost price, we must divide by 1.5. 4,470 divided by 1.5 is 2,980.
Yes. That's correct.
Then, I moved too quickly. On the 27th, they sell trading inventory for cash. Okay. So now, because they're selling it for cash, these two transactions are going to look more or less the same. The only difference is that the asset account that is going to increase is bank, because they are selling it for cash. Once again, sales is the contra account.
Yes.
Okay. But in terms of the trading inventory and the cost of sales, we're going to do exactly the same. We are going to divide the 6,950 by 1.5. And then we say,
Yes.
okay, so our trading inventory is decreasing, so we record it on the credit side. The contra account is cost of sales, and that's what is decreasing on the debit side. And I say decreasing, yeah, I mean it is our owner's equity
Oh,
that is
okay.
decreasing. Okay. On the 28th, they return 1,000 Rand worth of the stock they bought from SA Prop. Okay, so when they return it, it simply means that the money is going to go back into their account, but the trading inventory is going to decrease. Okay, so remember, this is from the previous slide here,
Yes.
where they bought the 10,000. Now they are just taking 1,000 Rand of that back. And then on the 29th, they received dividend income of 800 Rand. That money goes into the bank, and the owner's equity is also increasing, but on the credit side, and the contra account is called dividend income. Now, what you would possibly have noticed on there is that they are at least always giving you one of the account names in the question. So
Yes.
here they have dividend income, so you know that that will be one of your accounts. Here it was stock. Stock, another word for stock is trading inventory. So that's going to be a trade. Same here, trading inventory given. Here we have trading inventory. Here we have incredible computers. It's a creditor, so it must be creditors control. And here we have the owner takes, so it must be a drawing. So just read carefully and you will be perfectly fine.